Let's first start with a review of the material that we covered last class, at least the key elements of it. And I'm happy to welcome those of you who remember that today's class, not on Friday. There was a slight shift in the schedule, I guess, due to the holiday. So don't show up on Friday, okay? I know you just can't wait. So last class we completed our walk through the tax formula. We talked about tax base and how we arrived there in very, very broad strokes. We talked about standard deduction, right? And the calculation of it. We observed once again that it's comprised of two elements, basic and additional. And last class we zoomed in on the exceptions to the general rules of figuring out standard deduction. So for example, we learned that when it comes to excuse me, certain types of taxpayers, the government tends to treat them differently for the reasons that we discussed last class, starting with married filing separately, right? And we said last class, in terms of your filing status, we always look, and again, always is a tough word when it comes to law, there are always exceptions. So generally, we'll look at the last day of taxable year to see your filing status, right? More specifically, to see your marital status. So if you're married on the last day of taxable year, December 31, okay, the ball is dropping. And before it dropped, you're married. You're married for the whole year, right? Same time, some people come up with New Year resolution, and one way is to start single. So as the ball dropping, people get divorced before it ever drops. If you're divorced on December 31, you're divorced for the entire year. What a terrible tax planning, right? So we'll look at the last day of taxable year. We said we'll make an exception. We'll look at the day of death if the spouse passed away, in which case the question is, on the day of death, was spouse married or not? Okay. Same thing when it comes to your dependents. If a person was born the last day of taxable year, you have a dependent for the entire year. We don't prorate, we don't allocate. So that's very important to keep in mind. So to finish up with the exceptions to standard deduction first, those who are married but decide to file separate returns, the government says, remember, you could have either one or the other. Either you total your allowed expenses item by item, thus, in case people wonder why we call them itemized deduction, right? You itemize them, list them item by item. Or, if greater, you take standard deduction, but it's either or, not both, right? So if you're married filing separately, one spouse cannot take standard deduction, the other one itemized. Then it would be double dipping. Thus, you have a rule that says if one of the spouses itemizes, the other must itemize. And that's the first exception to the general rule in terms of how we figure out standard deduction. The other exception we'll learn dealt with dependents. Another category that gets special treatment from the government. Mainly the government tries to pull back on the benefit it gives them because somebody else already helps them by definition, right? If you're dependent on somebody else. So in those cases, the government says, look, while you still get additional amounts for being blind or 65 or over, the basic amount we're going to limit. What we give to everybody else, that's just top, ceiling of the basic amount. But we're going to start with the following, and you have that rule. that the basic amount of standard deduction of dependent is calculated as the greater of two amounts. Earned income plus $350, right? Or $1,050, whichever is greater. Now, a common mistake that I see is that this is where people stop. Okay, so it's earned income plus $350 or $1,050, that's it. Because if your dependent is blind, you add additional amount, right? If the dependent is 65 or over, you get additional amount. So please don't forget, very important. So the next question was, well, how do you claim someone as dependent? Or who gets these exemption amounts, right? And we said you get it for yourself as a taxpayer, right? You get it also for your spouse, that extra $4,000 last year, if you file joint return, right? If separate return, if your spouse filed separate return, it's still okay if you show that the spouse who files separately has no gross income, right, and not dependent on somebody else. Because again, remember, if your spouse is dependent on somebody else, somebody already grabbed that $4,000, it's gone. Okay? It regrows, but only once a year, not immediately. So if your spouse filing separately, as long as there is no gross income and not dependent on somebody else, you could get your spouse's $4,000 on your tax return. Right? So that's a second exemption amount. And the third exemption amount, whatever number of them, third way, you get for your dependents. Now, I taught you two ways, right, to qualify somebody as your dependent. And I made reference to a great summary. You guys all got excited about seeing numbers. Like, finally, we'll do some calculations, right? And he's not talking about it. We'll get there. So remember this chart? Okay? Make peace with it. Very helpful stuff. Okay? So qualifying child or qualifying relative. And it could be both. You could bring somebody through both routes. It doesn't mean you'll get it twice for the same person. It just means you could qualify them in more than one way. So you start with qualifying child, and that's first test, relationship test. Remember, all of these tests have to be satisfied before you're able to claim somebody as dependent. So you start with relationship test. And right there, you're up for a big shock, right? Because your qualifying child doesn't really have to be your child, as one would expect in this situation. So your qualifying child could be your descendants, so it's children, but also grandchildren, right? And again, please remember, anytime we talk about children, we're talking about also adopted, foster, and step, right? So please don't get confused. Grandchildren, right? Your siblings, as long as they're generally younger, unless they're disabled, then they could be older than you. And their descendants, meaning nieces and nephews. Joe was speaking. So keep that in mind. That's your relationship test. Abode means this person has to live with you for more than half a year. Unless there is a good excuse, we said, right? Exception. School, medical facility, so on and so forth. Support is another counterintuitive test. It does not say that you must support this person. Another mistake I see all the time people make. It simply means your dependent cannot be self-supporting. And self-supporting does not also mean, as we pointed out last class, that the person has enough money to support themselves. No. The question is, majority of expenses, were they actually covered by the dependent, him or herself? If yes, fail. Don't qualify. So it's okay for somebody else to support this person as long as the dependent does not support him or herself. Joint return really should say, and you could even mark in your notes, no joint return. because that's a requirement. If you want to claim somebody as dependent, the dependent cannot file a joint return as a general rule, right? Because there's an exception. Even though joint return was filed by your dependent, you can still claim his or her dependent if the one really required to file, and we studied last class what that means. We'll review today again. And the only reason the return was filed is to obtain a refund. That's okay. And you could have as many dependents as you want. Or I should say as many dependents as you could afford to support financially and emotionally. But for tax purposes, we don't care about that. And of course, citizenship and residency. Your dependent must be a citizen or resident of the United States, Canada, or Mexico. You need all 5. Then we jump to the other side, which is qualifying relative, which is broader in some ways, gives you more flexibility in some areas, but more limited in others. For example, support test, in order to qualify somebody as a qualifying relative, you actually have to support that person. And support means providing more than half. You don't have to support 100% or most of it. Well, more than half, 51% or 50.1%. Okay? And we're talking about basic needs: food, shelter, clothing, medical, education, right? Now, if there is no person who supports more than half, but there's a group that supports more than half, well, then we may get into multiple support agreement, right, situation, which says that any person in the group who contributes more than 10%, because the government says, look, you got to contribute meaningful amount. If you just give 1% or 2%, just forget it. Don't waste our time. Meaningful amount. What's meaningful? I don't know. More than 10% is meaningful. Okay, fine. Sold. Any person that's member of support group who contributes more than 10% could claim the person as dependent, even though they don't provide more than half. As long as every member of the group, every other member of the group, not really, those who provide more meaningful amount of support. What's meaningful? 10%. As long as every other member of the group who provides more than 10% of support agrees to it in writing. So even if you provide 11% of the support, as long as everybody else in the group who contributes more than 10% agrees to it in writing, you're good, claim. No proration, no allocation, no, okay, let's make it fair, consistent. No. One person gets it, but you could change it from year to year. So kids could get together and say, hey, younger sister, you're making a lot of money this year or last year. How about you take deduction this year? You could benefit from it most because we're all broke. Okay. All right? So that's your support test. Relationship or member of the household. Now, I'd like to, again, direct your attention to something very important. Relationship or member of the household. Like it's 2 ways to get out from Manhattan, right? Holland Tunnel, Lincoln Tunnel. There are other ways, but we're considering just 2 ways. Either this way or the other way. Okay? So don't mix up the 2 because it gets a little bit interesting when we talk about phantom relatives, like cousins, right? So first of all, the relationship test, that's our YMCA dance. You guys remember? You're super dancers at this point, right? So in case you forgot who your relatives are, again, we go up. It's your ancestors, right? Parents, grandparents, great-grandparents. It's your descendants. So right there you see it also covers same people as qualifying relative, qualifying child does, but it's broader. It's also ancestors. It's also aunts and uncles. In-laws, ex-in-laws, right? We said even though you think you're getting divorced, you don't get divorced from your in-laws for tax purposes, and that's a good thing because you could claim them as dependent if you happen to support them. Right? So big stuff. Remember, situation with divorces. In the year of divorce, you cannot claim your ex-spouse, but after the year of divorce, your ex-spouse becomes just like any other person on the street. which means the only way to claim them is they're no longer your relative, right? Which means the only way to claim them is how? If you go through the other tunnel, which is member of the household. They have to live with you for the entire year. So that's true of anybody. Boyfriends, girlfriends, ex-spouses, cousins. I want you to really make a mental note that cousin is the same thing as a friend. It will make it so much easier for you. Because immediately you got these triggers. Okay, relative, and then you get confused. No. Cousins are not your relatives. You already crossed them out from the family picture. Remember? That's it. Done. Gone. Forget it. You don't have to talk to them anymore. You don't have to invite them to family dinners. Finally, dream comes true. Blame it on me. What is that song? Blame it on what? Tax professor? Okay? So very important. Gross income. Dependent's gross income cannot exceed what? Forget about $4,000. Last year was a different amount. Next year is going to be a different amount. Exemption amount. Whatever it is that year. Easy to remember. Okay? Joint return, same story. Citizenship of residency, same story. Okay? Nothing new. You can just put same rule as qualifying child. Again, you need to satisfy all the tests. Sometimes people get excited. They see, oh, okay, I satisfy first, done, support. Wrong answer. Okay? So that's how you claim somebody as dependent. Okay? Now, we talked about filing statuses, but I want you to appreciate the consequences, or at least some of the consequences of filing status. So, for example, excuse me, 2015. Where did I put my pen? Okay, we'll pretend this is my pen. So, how do we calculate taxes? Okay, first of all, please notice percentages, rates. Okay? These are called statutory rates. They're prescribed by statute, which is a law. Okay? 10%, 15, 25, 28, 33, 35, 39.6. Okay? That's our highest rate. Federal income tax, that is, right? That's where we are. The highest rate that's applicable to your taxable income, because again, these rates is what we're applying against taxable income. Remember the tax base? It's all about the base, remember? So that's what we were calculating, and we'll be figuring out the whole semester. What is our tax base? And ultimately, you apply percentages to. The highest rate applicable to your taxable income is what we sometimes refer to as tax bracket. What is your tax bracket? You'll see and hear a lot of press and talk about it, about your tax bracket. Why do you need to know about tax bracket? Well, you understand as we'll go through. First, I want you to appreciate how the system is being taxed. One thing you'll notice immediately is that there is not necessarily one rate that's applicable to your income. So we're taxing it in layers, like a cake, layered cake, right? The first layer gets more or less cream, then less or more. So look what it says here. It's very intuitive, actually. If taxable income is over zero, but not over $9,225, the tax is 10% of what? of the amount over 0, whatever that layer is. So the first layer is up to, for single people, right? So single filing status. First, $9,225 is taxed at 10%. That's your first layer. 10%. Cheap. Right? Next layer in our income cake, between 9,225 and 37,450 is taxed at what rate? 15%. What is that 922.50? It says the tax is 922.50 plus 15% of what? Of the amount over the prior layer, right? This is really the tax on the first layer. They just did it for you. You guys follow? Yes? Right, because the only way you get a to second layer is if you fulfill completely the first layer. Otherwise, you never get there. So they're assuming then your income on the first layer is up to 925. Otherwise, you'll never get to the next layer, right? So that's why it's 922.50 plus 15% of the next layer. And so on and so forth until the highest layer, if you're single, $413,200. So somebody tells you they're in 39.6% tax bracket. What do you know now? And they're single. They're rich. You know that their taxable income. They could make $1 million, but with all the deductions, which we'll study, all the planning, their taxable income has to be over $413,000. It's a good person to say hello to. Okay? So you could be somewhere in the middle here, and your highest tax bracket will be 28%. So if somebody's asking you, what taxes are you paying on your income? What tax are you paying on your income? Is it 28%? So it's really, on average, what are you paying, right? So whatever that amount comes into be, you divide that by your taxable income, and that's the true rate, your average rate, right? So we'll get to talk about more about average, marginal rates, and everything else, but I just wanted to give you a perspective. Now, look at something interesting. Somebody was attacking me last class after the class. I'm joking. But they're saying, what's the point of getting married? Seriously, we had this conversation. I don't see any benefits of getting married. So I tried to explain, well, there's some benefit, for example. Let's look at married filing jointly. Look at 10% until what amount it goes? $18,450. Right? I love when you guys attack me, so please continue to attack me. It was a joke. Okay? So it means, now, if you're single, you're making this. So let's say you're single, right? And you made $18,450. What is the highest rate that's going to be applicable? 15%. What if you go out and meet somebody? Now, some of you, of course, are shy and don't know how to start conversations, right? So I'm going to teach you a few tricks here. It's a good time to take notes. So you walk in the room, you see somebody you like, you don't know how to start a conversation. The first thing you ask is, hey, what's your tax bracket? They're going to be so shocked and believe you're so original that I don't think they'll ignore you. Did I tell you how Mary and Joe met, my former students? Actually, one of them was my former student. The other student was from a different school. It's exactly how they met. She came up to him and said, hey, what's your tax bracket? Now, he didn't go to this school, so his tax bracket was 0. And she really liked him. She goes, you know, I have an idea. purely for tax planning purposes. How about we get married? Anything we ever did with my wife, it was always for tax planning. At least that was always my excuse. So look what happens. And she showed him. She pulled out her notes from class. And look, right now, I'm making I'm still a student, but I'm making $18,000. I'm getting to 15% tax bracket. If we are together, and you continue to be a loser, God forbid, but for now, I'm going to save money because the maximum rate is going to be 10%. Do you guys see this? Anybody ever now is going to wonder why get married? Okay, so right there. Now, of course, the situation could change. Of course, one person could go, but this is one of the examples. Now, very interestingly, we discussed theoretically, certain status is better than others, but let's get a visual of it. If you are head of household, is it better than being single? It depends. For tax purposes, rate-wise, seems like, right? And I agree with that. Because now, the 10% goes up until $13,150. Versus single, $9,225. So that's better. Now look what they're doing with married filing separately. They're putting them back as if they were single, right? And they take away some other benefits. So play around with this. I just want you to memorize it for the first exam, okay? These charts. No, just kidding. You don't need to memorize them, but I just want you to understand how things work, okay? Any questions on this? I generally don't take questions when I go through the review, but after the review I'll be happy before we start. And I just wanted to touch this before we discuss more. Yeah, that was my example. If your spouse is staying home, okay, that was my argument to my wife. We get married, you stay home, I save on taxes. She agreed to marry me for that reason alone. Then I explained to her the benefits of having kids. So as I said, the situation could change, of course. Yes? Well, we could take a look. So this is prior year. And you could see the first layer was lower. So the answer is yes. Okay? It was 9075 versus this year it's 9225. Okay? The rates don't change, the brackets change. All right, so let's continue with this. When we talk about, I just wanted to give you some visuals so you could appreciate other dimensions of filing statuses. So head of household we talked about, right? I'm purposely going slow. This is the beginning few classes. I want to make sure you guys have it. Okay? Then we'll pick it up. So head of household, you cannot be married, unmarried, and you have to have a dependent who lives with you, right? But that dependent has to be your relative, very important. Again, relative. That's the YMCA dance, right? So even though you could have a dependent who's your friend or cousin, they're the same. Can you be a head of household? No. Unless you have somebody else who's actually a relative who's your dependent, right? And we said, well, your dependent has to live with you for you to be a member, head of household, by definition, right? Your parents don't have to live with you. That could be elsewhere. You could kick them out. Shows something about our culture. Yes? Forget about cousin. I'm really suggesting to erase the word relative when you talk about cousins. Otherwise, you're going to be confused for the rest of your life. When you say cousin, think friend. And then you'll answer your own questions. Friend. So you could have a friend as dependent if they live with you. But friend is not your relative. So for the purpose of being head of household, you cannot have dependent. You're only dependent if is cousin, you're done. You cannot be a head of household. Okay? As long as you're going to be connecting cousins, relatives, you're going to be in the wrong space. Okay? Now, we talked about abandoned spouse rule, right? And we said, well, even though a person is married, if they didn't live together for the last 6 months of the taxable year, cannot file joint return. Because remember, to file joint return, we discussed joint and several liability. Each person has to sign a return. If that's not possible, and you have a dependent child, once again, not qualifying child, what's the difference in child and qualifying child? Qualifying child could be your brother, right? It's a term of art, legal term. If you have actual child, your own child, and again, when we say child, stepchild, adopted, foster, then you qualify as an abandoned spouse, which means, big picture moment, even though you're married, you file as a head of household instead of married filing separately. And we got the visual why it's better in some ways, and we got others. Then we talked about who has to file, right? And I gave you a general rule. Must file if gross income equals or exceeds sum of two amounts. Standard deduction plus exemptions, right? And when we talk about standard deduction, remember it's basic plus additional, right? But in here, you don't add additional amount for being blind. We ignore blindness, right? That's the general rule for everybody. Now, we start playing around with these elements, because if we talk about married filing separately, these guys lose what? And I gave you a quick way, if you don't remember the rule, to think about it. If you're married filing separately, if one of the itemizes, the other one must also itemize, which means they'll lose what? So they'll lose standard deduction here. And the rule basically says if you're married filing separately, you must file if your gross income equals or exceeds what? Exemption. That's it. Exemption. Special rule for married filing separately. And if you're dependent, I gave you the rules, right? You have this, if your gross income, blah, 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 blah. But in reality, in most cases, it's going to be what? What do dependents lose when somebody claims them? Their exemption, right? So exemption is lost. What's left? Standard deduction. So as a general proposition, dependents must file their gross income equals or exceeds their standard deduction. But remember, how do we calculate dependent standard deduction? It's the greater of two amounts, right? But not to be equal, not to be greater than what's given to everybody else. And they do get additional amounts for being blind and over 65. And again, there are situations where there's an exception to it, but you have the more detailed rule. This is just a quick way to think about it. There's another exception, interestingly enough, when we talk about who has to file, and the government makes that exception for self-employed people. Do you remember that rule? Self-employed people must file if what? Net earnings exceed exactly about $450, so $400, right? What's the latest amount? $400, right? Self-employed people must file if their gross income, if their net earnings equal or exceed $400. I have a question for you. Is that low? What's your exemption amount like for dependents? $4,000. Everybody else, sometimes $10,000, $12,000. For self-employed, it's $400. If your net income $400, you must file. I have a question. Why such low amount for those who are self-employed? Anybody? Doesn't seem strange to you? Are we targeting? Are we discriminating? Is it good or bad? But let's start with that. If you must file if your net earnings $400 or more, such low amount, is it good for taxpayers or bad? It's bad because more of them have to file tax returns. Otherwise, they wouldn't have to. So why? Make sure they pay tax. Well, doesn't the government want everybody else to pay tax?
I think it's because you can claim business expenses, so you can,
If you're self-employed, what does it mean if you're self-employed? You have your own business. So you're saying they could claim expenses and thus lower the net earnings. My friends, the bottom line is we don't trust them. We don't trust them. Why? Exactly why? Because you're in control. If you're making money and somebody pays your salary, you get W-2 at the end of the year, you got other forms. But if you're self-employed, you just manage your own books and you show to the government what you show. The government says, hey, oh, we understand, but did you make at least $400? Yeah? Okay, file, then we'll talk. There was a very interesting case. Because usually I get this question, well, how will the government find out how much you made? You know, there's this everlasting question that I'll have and I'll be getting throughout probably for the rest of my life. How will they know? So to this question, there's a famous case. IRS was auditing laundromat. Because how do they find out? They audit you, but how do they really find out? So the owners were showing something like $30,000 a year in income. Government came in, audited, and showed that actually they've generated $150,000 about. How do they know? How do they know? You come in, you know, there's just machines standing there. You know, people when they use it, they throw in quarters. How did they know? You compare it to other businesses. So, what does that mean? Well, that could be maybe some type of red flag, but it wouldn't tell you. They made $150,000. In fact, it was like $152,375 or something like this. It was pretty precise. And no, there was no undercover agent sitting in one of the machines. Okay? No. Another quarter. Come on, guys. Think. You're future IRS agents. IRS hires a lot of our graduates. Yes. Check machines. These owners made sure machines don't keep track of the number of cycles. They can inflate their expenses too much. That's what we're talking about. But the government says you can inflate whatever you want, but we know how much you generate in revenues. How did they know? Yes. Use utility bills. Exactly. Show us water bills for the year. Why? Oh, just curious. We have nothing to do. We just want, a big water bill. And how much does this machine take water per cycle? Interesting. Exactly. It's pretty cool, right? You can't argue you take 15 showers every day in your laundry business. Pretty good stuff. We have annual IRS symposium that I run in December where we have senior IRS people and line audit people, and we discuss different trends, situations, and some of these stories sometimes come out. Very interesting stuff. In our graduate tax programs, I have few current IRS agents who are teaching there also. Actually, a few of you asked me about our graduate tax programs, and I promised to say a few words during the class so that I don't have to say it 250 times to each of you. So, pretty cool programs. It's actually 1 year only. And it's only tax. The advanced tax courses. So partnership, corporate, estate planning, international, real estate, whatever. Okay, 10 courses. And you get your master's degree. Master's in tax. And you can go full-time, part-time, or flex. I designed the classes so they start after most people, our students, work. So the classes start like 5:40, 6 o'clock. So you could have a full-time job. And you could finish at your own pace, which is pretty cool. And they're taught, besides our faculty, by some of the top partners from the major firm and some of the senior IRS people. And they've been rated very well by, in fact, our graduates get awards and recognition every year from Tax Executive Institute, which is pretty cool. Okay. So, and being full-time, if you're full-time and you're an international student, that also helps you out and certainly counts towards your CPA certificate. Okay, so I hope that helps. And you can start in spring, so it's either spring or fall. So you have if you go full-time, it's 4 classes fall, 4 classes spring, and 2 classes during summer, and you're done. Or you could stretch it for the rest of your life if you wish. Some people just love academia, I guess. All right, so moving right along. Historically, about 20% of you get enrolled into our graduate tax program classes immediately. And most of the employers and major firms, they'll pay for it, which is pretty cool. All right, so moving on to bigger and better things. So today, I wanted to cover interesting topic, and that's capital gains. It's going to be part of the conversation during this election cycle, so it's always relevant and it's always hot topic, highly debated, but let's make sure we understand it. Before we get into details, again, it's very important for me to make sure that you guys understand the big picture. Because sometimes we get lost in details and we just don't know what we're doing, why we're doing, where we are, and all that stuff. So the big picture is, we learned all these rates, right, that apply to your income. And we also know that the government uses tax system in many ways, one of which is to generate revenues. Another way is to encourage or discourage certain type of behavior. And how can you encourage certain type of behavior using tax code, for example? Yeah, you could tax less. If you make money in certain type of activities, we'll tax you less. Ooh, interesting. You're telling me if I shovel, I pay 39%, but if I do something else, I could pay 0 or 5%? That sounds good to me. Let me look at that, right? Because it becomes more profitable. So this is what it's all about. It's certain type of activities which the government says will tax you less. That's all. Okay, so now let's discuss details. So in order to deal with special rates are applied to special type of income and special capital gain income. And special type of income is applicable to certain assets that generate this income. So we have to start, logically speaking, with the first question is, what is this special asset that the government wants me to do something with? To invest, hold, and all that stuff. And those assets are called, naturally, capital assets. Capital assets. So the question number one is, what is capital asset? Can somebody tell me, based on your reading so far? What is capital asset? Your property? So I'll give you 2 ways to think about it because, all our brains are different. We all think differently. The rule, actually, if you follow the code the way it's written, it says the following. Capital asset, and I suggest you write it down. Capital asset is, you ready? Every asset you can possibly imagine. I'm translating legalese into pure English. Every asset you could possibly imagine. You got it? Except. Oh, you thought it was going to be that easy? Every asset you could possibly imagine except, number 1, inventory. accounts receivable, three, property used in a trade or real or intangible property used in the trade or business. Real or intangible property. Real property. You know what real property is? What is real estate? Like land, right? Or buildings. Real or intangible property. What's intangible property? Like trademark, copyright, right? Patent. Used in a trade or business. You got it? So every asset you could possibly imagine except for accounts receivable, inventory, depreciable real properties in trade or business. Okay? So, question for you. You ready? My car, is this capital asset or not? You guys are good. Can't trick you no more. That's right. It depends. Do I use the car in a trade or business or not? Right? So another way to look at this definition, we just said what it's not, right? Capital asset, everything except, right, what it's not. To say, look, capital asset is really property used for investment or personal use purposes. So another way to look at this definition, what is capital asset? For those of you who like it better, it's something used for personal or investment purpose. In other words, not in trade or business. You got it? So now, if I say car used for pleasure, is this capital asset? Yes. Okay? You need to know how is it used. Otherwise, no way to answer. All right, so we know what capital asset is. Is it enough to sell capital asset and make money and pay less taxes? No. The government also wants you to hold this asset more than a year before sale. By the way, is it a year or more than a year? It's more than a year. Don't confuse. More than a year. Because technically it's long-term capital gains that get special treatment. A long-term capital gain is the gain derived from the asset you held long-term. What's long-term? More than a year. Okay, you got it? So, if you have long-term gain now, if you held the asset over a year, congratulations. You get special rates. What are these special rates? You have a nice chart that you could refer to at your leisure on page 30. So short-term capital gains are taxed at the highest of 39.6. It means it's regular income. It's whatever your tax bracket is. You could go as high as 39.6%. Nothing special because you didn't make it special. You didn't hold it long-term. So the special rate will apply to long-term. Don't worry about this middle part for now. Long-term capital gains, 20%, 15%, or 0. Oh my God. So first of all, what does 0 rate mean? What rate is 0? What kind of taxes you pay if the rate is 0? 0. It means they will not tax you in certain situations, okay? So the next interesting question, so which one is it, 0, 15, or 20? I'm confused. Answer. It depends. Don't be confused though. So the answer is it depends on your tax bracket. But these rates, and one way to logically think about it, forget about 20% for now. It's really 0 or 15. 20% applies if you're in the highest tax bracket, 39.6%. If you're in 39.6%, then you're going to pay 20%. All the other ones, 0 or 15, depends on your tax bracket. And the way to think about it is, this rate's supposed to make your life better, but not too good to be true. Meaning, if your regular rate, let's say 25%, what do you think rate is going to be applicable to your capital gain? 15. If your regular rate is 15%, what's going to be the rate? 0. 10%. 0. 39.6%. 20. 35%. 15. 20% is only if you're in the highest tax brackets, which is 39.6%. Otherwise, it's either 0 or 15. So, interesting situation. You go out today, I think it snowed a little bit, right? You grab a shovel, and you shovel, and somebody pays you $9,225. How much in taxes are you going to pay? Federal income tax, $922.50, which is 10%. But instead of shoveling, you're just sitting home. And a year ago, you bought your car to use for pleasure or investment, and you just sold it, and you made $925, $225, $9,225. Same amount. Easier made. How much taxes are you going to pay? 0. In fact, you could have made up to how much? $37,000 in trading stocks, or making other investments, or buying and selling personal items. And you pay 0 taxes. Can you believe that? Is this crazy? This is the power of tax planning. There are whole divisions and firms where tax professionals are utilized to the extent possible, convert regular income into capital gain income, so you pay 0 taxes or less taxes. Look at this. This is 0 tax. If you're in the highest tax bracket, you pay 39.6%. If it's capital gain, though, long term, you pay 20%, half of the taxes. Are you beginning to appreciate what tax is really all about? It's not about filling out the tax form. It's about making a lot of money and paying very little in taxes through tax planning. That's what profession is all about. Okay? Very important. So let's continue with this. Let's make it more interesting, because I know you guys like to complicate things. You guys like to complicate things? Life is too boring without complications. And without complications, we don't appreciate the simple things in life. So you may be sitting there and wondering, interesting, interesting, very interesting. But, Professor, tell me please, what if we don't make money? What if we have losses, capital losses, right? Because sometimes we'll lose money. Answer, I have good news for you. Why? Because if you lose money and you have capital loss, how can you possibly have capital loss? If you sold capital asset at a loss, right? The loss is deductible, right? You could deduct it. What kind of deduction is this? Above the line or below the line? Above the line. Very good. Is there a limit on how much you could deduct above the line in capital losses? $3,000. So if you lost $100,000, you could deduct this year against regular income keeping everything else the same, $3,000. What happens to the rest of the loss? $97,000. It gets carried forward. Meaning, next year, you'll use up whatever the losses you have, but up to $3,000 against income again. How long can you carry it forward? Forever. Forever, ever? Forever. I only have good news here. Forever. Okay? Now, can you have a long-term capital loss and short-term capital loss? Yeah. You sold long-term assets, short-term assets, but as far as deduction from against ordinary income, it doesn't matter. It's still $3,000 per year. You got it? Oh, that's so interesting, Professor. I see. I see. What if you have both gains and losses during the year? And how about making it even more complicated? Long-term gains and long-term losses, short-term gains and short-term losses. Can we just lump them up and net? Kind of. What's the problem? The problem is that if you end up net with long-term gain, you want to know that, right? Why? That's right, because you'll pay less taxes, right? Because long-term gains is what gets special rate. So the government says, well, if you have everything, long-term gain, long-term loss, short-term gain, short-term loss, let's say 10, 2, 5, I don't know, 3. Then the government gives you netting rules. They're quite logical, but I want you to write them down anyway. If you have both long-term gains and long-term losses, short-term gains and short-term losses, we have netting rule. First rule, you got it? Ready? You net long-term with long-term. Long-term gain with long-term loss. What do you get here? 8. How do we call it? Long-term capital gain. We got to keep track of it, right? Because we want to know if we're going to end up with long-term capital gain, we said already. It's like an absolute big fish eats small fish. If the gain was bigger, you're going to end up with gain, right? In absolute terms. Same thing here. You get 2. How do we call it? Short-term capital gain. Right? So where are we now? We ended up with 8 long-term gain and 2 short-term gain. There's nothing else to net here. We stop. Right? You don't net positive with positive. Do we just add them up? No, because then we'll lose the precious stone here. The precious stone being long-term capital. So you stop right here. And you say, okay, how is this taxed? $2,000 short-term gain. Nothing new, just like any other income, whatever your tax bracket is. What about this? Ooh. Now, what's your tax bracket? 15%? 0. No taxes. Right? If you're 39%, what's the tax rate going to be applicable to this income? 20%. Amazing. Do you feel it? Do you feel the thrill? Or by now in your 3rd year, the thrill is gone? I went to see B.B. King in one of his last concerts. He was giving it in Miami. Very interesting man. It's like, I think, a month before he died, or a few months before he died, or something like this. Okay, so now you're saying, well, I understand, but you know, you guys like to play with numbers, right? You're accountants. Okay, so let's change this around. You ready? Any questions on this before we move forward? Okay, so let's say it's not too positive, whatever the numbers are. Let's make it too negative. So short-term capital loss. Okay, so this would have to be what, 7? Right? So you net them, what do you get? 6, long-term capital gain still. So you just apply a special rate. That's it. There's no more short-term gain. Any questions? Comments? Friendly remarks? Easy so far. No questions? Let's change it up. Let's make it, ooh, I don't know. Let's make it negative here. And let's say this is positive. So you net them and you end up with 6 long-term capital loss. Right? Let's say this is, again, back to 3. So what do we do here? 6, long-term capital loss. Above the line deduction, how much? 3,000. That's it. And the rest gets carried forward. Is that clear? Okay, last example. Now it's going to get really exciting. Are you ready? Let's say at the end, you end up with 3 long-term capital gain, loss, short-term capital loss. Now, this is going to be a brain-stretching exercise here, which we do daily. But this is going to be a special brain-stretching exercise. Question number 1. Well, we know what's going to happen somehow, right? 3,000 is going to be deducted against your regular income. The other 3,000 will get carried forward. Question number 1, ladies and gentlemen. Do you care? Ladies and gentlemen, do you care which 3,000 you deduct this year and which gets carried forward next year? Presuming, which is true, that whatever the qualities of this loss are, whether it's long-term or short-term, they're going to stay the same for next year. The loss doesn't get older, unlike us. So if it's short-term this year, it's going to be short-term next year when you get it carried forward into next year. Is that clear? Question numero 1. Do you care which one to deduct this year and which one to carry forward next year? Okay, those who care, please raise your hand. Okay, so we have some people who care. That's a good thing. Question, why do you care? Could somebody explain to me why? It's a very tough question. I have to tell you this. It's a very tough question. But it's fun. Yes. You want to deduct older debt first, so you knock out long-term capital loss this year, you applied, and short-term gets carried forward into the next year. Why do you want to do it that way? You think in the right direction. Yes. So what would make it consistent? I think either one would make it be consistent. Long term, short term.
It depends on what you
Oh, interesting. How interesting. Did you guys hear it? He said, I have no idea. No, that's not what he said. What's your name? Alex said, well, it depends. So far, so good already, right? It depends on what you expect next year. Oh, how interesting. So let's say next year, you end up with, also, just to keep things simple, $3,000 long-term capital gain and $3,000 short-term capital gain. Let's say this is what you expect. So, you're almost there.
Well, in that case, it wouldn't matter because
It wouldn't matter.
gain is canceled out.
So it doesn't matter. You deduct this one, this carries forward, you cancel it out. How do you cancel out, by the way? Remember, there's a rule. It's long term with long term and short term with short term. Huh? Does it matter now? Or does it still doesn't matter?
Well, in this case, no, but if, let's say you had a negative, like -3 long-term capital loss,
Carried forward here.
like in there, yeah.
So if you have long-term capital loss carried over here, then you just knock it out against this, right? You net long-term against long-term.
Yeah, but if like,
Wait. So what do you end up with? Well, you end up with 0 here, but here you end up with what? Short-term capital loss. Do you pay any special taxes with this? It's short-term, Alex. No. So you pay 36.9%. Is that a good thing? No. Wouldn't you rather cancel out this one and end up with this one? Yes. Wouldn't you rather carry forward short-term capital loss? This way these two cancel out and you end up with 3 long-term capital gain and pay half of the taxes or no taxes at all. Isn't that better? Yes. And to accomplish this, to carry forward short-term capital loss, you have to deduct this year what? You have to deduct this year long-term. So you carry forward short-term. Don't anybody writes it. No, nobody writes anything. You have to resist the urge. Did everybody just follow the brilliant tax strategy that Alex just developed with us together? Do you understand? Do you not all care which one to deduct this year? Because if you deduct long-term this year, you end up with more money in your pocket. Because you carry forward short-term, which eliminates, because remember, the netting rule is long-term against long-term, short-term against short-term, right? And you end up with long-term capital gain, you pay less taxes or no taxes. But if you deduct short-term first, then long-term gets carried forward, and you have to net long-term with long-term, you end up with short-term and pay more taxes, which is good or bad? Whenever in doubt, more taxes is bad. Keeping everything else equal. And more money in your pocket is good. Everybody understands it? That's called tax planning. Now, what does the rule say? What do you do in these cases? Anybody read? They said deduct short. So the government says, you cannot do this. What do you mean we cannot do this? The rule in your book says if you have both long-term loss and short-term loss, the government says you must deduct this year short-term loss first. Bad people. So you say, wait a second, this whole thing that you just put poor Alex through was complete waste of time? You mean we really have no choice? Answer. No, it was not a waste of time. And yes, you still have a choice when it comes to tax planning, and I'll show you how. But first, I'd like to explain to you something. What we just did with Alex, this is called tax planning. A lot of people asking me, so what is taxes all about? What is taxes all about? It's about planning. It's about structuring your transaction, figuring out what to do, when to do, how to do. So this is just an illustration, number one. It's like puzzles. Those of you who like puzzles will enjoy taxes, number one. Number two, yes, the rule says you cannot do it. And by the way, in case you're wondering, how do rules get developed? This is a perfect example of rule-making process. This is exactly what taxpayers used to do until government woke up one day and said, huh, that's what they're doing. It's like, remember we talked about estate tax and gift tax? I'm going to die broke. Oh, that's what you want to do. You want to give away everything during your life? Back door, gift taxes. We don't care how you're going to get away. Same thing here. Oh, that's what you're doing. Okay, now we're going to have a rule. Okay? Short term first. So now you understand the rule-making process, perfect example. The third lesson, priceless lesson here. So knowing that there is such rule doesn't mean you cannot get to this situation anyway. Answer, you can. But not by violating the rules. By planning your transactions. What do I mean? If you're sitting in two assets, and listen carefully. If you're sitting in two assets, and for those of you who are confused and puzzled, right now I'm going to have great news for you in just a few moments. Okay? But we'll get there. If you're sitting on two assets, and you know you're going to sell them, you want to sell them, right, and see your end. You know if you're going to sell them both and each going to have a loss, you know what the result is going to be. You're going to be forced to take this loss and it's not good for you. But knowing there are these rules, you come to a tax professional, you being knowledgeable tax planner, what do you say to yourself, your friends, your clients? Well, if you don't care what to do, then you know something? Hold on. Don't sell this now. Wait another day till January 1st. Sell this. Take this deduction, and you get the result you want. Tax planning. The difference between tax planning and tax evasion. Remember we discussed class 1? Tax evasion, fraud, violation of the law. If you simply take both and you just apply it the way you want it, that's violation of the rule. Knowing the rule is power. You can do tax planning. So this is a priceless exercise on so many different levels that I just described to you, okay? Because the difference is huge. In this example, it's a game of how much, what is the percentage you're going to pay on the income? Maybe nothing at all if you get into zero tax bracket. It's saving thousands of dollars in taxes, or millions of dollars, depending what you're playing with. Okay? And we tax experts have the toys at our disposal. One of them is these different tax rates that you could utilize. Now, for those of you who got confused with this stuff, don't worry. This exercise, this mental exercise that I just took you through, I will not hold you responsible for it. Whew. All you need to do, and everything that I could have done at the beginning of this conversation, is skip the 20 minutes or 15 minutes, whatever it took us, and just giving you the rule, which is if you have long-term loss, short-term loss, short-term loss deductible first. That's it. But you would miss the whole world. So I wanted to expose all of you. I know about 25, 30, 40% appreciated it. The other 80 also appreciated it, even though they didn't get the details, and that's okay. You could sleep on it, talk to your boyfriend about it, a girlfriend. See if they're still with you after that. But you get an idea, okay? But for your purposes, the only thing I want you to know is the netting. First, you net long-term with long-term. Second rule, short-term with short-term. And next, if the results of opposite sign, like we did, you net again. But only if the results are of opposite sign. Otherwise, net losses against ordinary income. If you have both long-term and short-term deductible. That's it. But I know many of you appreciated this bigger picture because this is what the world is all about. Yes? One more time and louder, please. Oh, you want me to, okay, so I gave you the rule. The rule says you must deduct short-term first. And if you have a choice which to sell, you want to end up with short-term loss here, right? So you don't sell this asset. You wait till January 1st, then you sell it, presuming it's not going to get that extra day or month is not going to get you into a long-term situation. And you just sell this. So you take a loss, long-term loss this year, and short-term loss essentially gets carried forward to next year because you don't sell it this year. So there is no loss this year. And if you sell it next year, you're going to have this short-term loss next year, and which is what you want because you want to offset it against short-term gain. This way you end up with long-term gain and pay less taxes or no taxes. You are very welcome. Whew. All right, so this was fun. There's nothing else that I'd like to say about capital gains and losses at this point. Okay? So what I'd like to do next is move to the next chapter. Yeah. You net again. Yes. Like we said, the big fish eats the small fish. So whatever is, if the long term is high sign, you end up high in absolute number, you end up with long term, whatever that is. If the short term is a bigger, and whatever you're netting against, then it's going to be short term that you're going to end up with. Yeah, good question. Thank you. Okay. So I'd like to move to bigger and better things, and